This topic is about revenue recognition, from learning module analyzing income statements. Income means increases in assets or decreases in liabilities that lead to higher equity, but not from owner contributions. Option A. Loan increases a liability. That's not income. Option B. Owner contribution increases equity. That's capital, not income. Option C. Cash received for services increases assets. That's income. Correct answer is C. Start with gross sales $5 million. Subtract returns $300,000. Net revenue $4,700,000. Net revenue equals gross sales minus returns or allowances. Correct answer is A. If Mega Marketplace is the principal, it would record the full $10 million as revenue. But here, Mega Marketplace is only an agent. It does not control the goods, it just earns a commission. As an agent, it only recognizes the commission as revenue, 15%. Correct answer is A, $1.5 million. In a consignment, the manufacturer still owns the goods until the retailer sells them. Shipping the goods to the retailer does not mean revenue yet because control hasn't passed to the end customer. Payment from the retailer also doesn't trigger revenue because it depends on the retailer's sales. Revenue is recognized only when the retailer sells the goods to its customers. Option A is correct. The company sells a 3-year contract for $900. Efforts are equal each year, so revenue is spread evenly. $900 divided by 3 years equals $300 per year. In the second year, the company recognizes $300. So, equal effort means straight line allocation. Correct answer is B. When cash is received before earning it, the company cannot call it revenue yet. Instead, it records a liability or deferred revenue because it still owes goods or services. The answer is B. The company bought parts for $500,000. It sells them with 25% markup on cost. Revenue is based on the selling price, not the cost or profit alone. Selling price equals $500,000 times 1 plus 25% markup equals $625,000. Principal means reports full sales price as revenue. Markup means revenue equals cost plus profit. Option C is correct. Total contract 50 machines for $1 million. Revenue is recognized based on progress, units delivered. In year 1, 12 machines delivered. Progress equals 12 divided by 50 equals 24%. Revenue equals 24% times $1 million equals $240,000. This topic is about expense recognition. Expenses are recognized when the company uses up the economic benefits of an expenditure. It's not about when cash is collected or paid. It's about the timing of consumption of benefits, such as using inventory, consuming services, depreciation of assets. Cash collection or payment is not expense recognition. Expense recognition happens when benefits are consumed. Option C is correct. Before adoption, the company expensed contract costs. They reduced net income immediately. After adoption, the company capitalizes those costs. They go on the balance sheet as an asset and only reduce income later through amortization. So in the year of adoption, expenses are lower. Net income looks higher and assets look higher too. Option C is correct. This topic is about non-recurring items. A tornado destroying a warehouse is an unusual or infrequent item, but the company is still operating. Under IFRS, such losses are reported in income from continuing operations. They are not discontinued operations. Discontinued operations when a whole business segment is sold or closed. They are not other comprehensive income. Other comprehensive income is for items like foreign currency translation or unrealized gains or losses on certain securities. When a company changes an accounting policy voluntarily, IFRS requires it to apply the change retrospectively. That means the company must restate prior periods as if the new policy had always been used. This ensures comparability across years. Prospectively means current or future only. It's for changes in estimates, not policies. A separate line item adjustment is not the correct treatment. Option B is correct. A change in accounting policy, like inventory valuation method, must be applied retrospectively under IFRS. That means the company must restate prior period financial statements as if the new method had always been used. Prospectively is only for changes in accounting estimates, like useful life of equipment. A cumulative adjustment line item is not the correct treatment for policy changes. Correct answer is B. Before 2015, US GAAP allowed extraordinary items for unusual and infrequent events. ASU 2015-01 eliminated that category. Now, such losses are shown within continuing operations, but separately disclosed if material. They are not discontinued operations. That's for disposal of a major business unit. They are not below net income. So, extraordinary items eliminated after December 2015. Change in accounting policy, like switching inventory methods, must be applied retrospectively, restating prior periods as if the new policy had always been used. Change in accounting estimate, like useful life of equipment or bad debt allowance, applied prospectively, affecting only current and future periods. They are treated differently because a policy change affects comparability across years, while an estimate change reflects updated information. Policy equals retrospective. Estimate equals prospective. The correct answer is A. This topic is about earnings per share. Time weighting is key. You do not simply add the 500,000 shares to the total. Because they were only issued in April, they only count for 75% of the year, 9 out of 12 months, in the weighted average. Always check for preferred dividends first. If they existed, you would have to subtract them from the $5 million before starting your division. Diluted EPS is only different from basic EPS if there are potentially dilutive securities, like options, warrants, convertible debt, or convertible preferred stock. Here, the company has only common stock and non-convertible debt. That means there are no dilutive instruments. So, basic EPS equals diluted EPS. In the diluted calculation, we ignore the $2.5 million in preferred dividends. We assume those shareholders are now common shareholders, so that money stays in the pool for everyone. Diluted EPS must always be equal to or less than basic EPS. Basic EPS for this company would be 3.125. Since our result of $2.14 is lower than $3.125, the security is considered dilutive. Unlike convertible bonds or preferred stock, options never change the top number, the numerator, of your EPS fraction. In the money rule, we only do this calculation if the market price, 40, is higher than the exercise price, 30. If the market price were lower, nobody would use the options, and they wouldn't dilute the EPS at all. Basic EPS here is $5. Since $4.96 is lower, it is truly dilutive and must be reported. Basic EPS is always calculated using actual net income and weighted average shares. Warrants and options are handled under the Treasury stock method, but only when calculating diluted EPS, not basic EPS. Diluted EPS can be equal to or less than basic EPS, depending on whether the securities are dilutive. It is not always less, sometimes equal if anti-dilutive. Basic EPS never uses the Treasury stock method. Option B is correct. We do not simply add the 20,000 options to the total. Because the company gets cash from the options, we assume they use that cash to reduce the dilution by buying back some shares. In the money rule, this calculation only happens because the market price, 40, is higher than the exercise price, 25. If the market price were lower than $25, nobody would use the options, and the denominator would stay at 800,000. Stock options use the Treasury stock method. They only affect the denominator, shares outstanding. Net income is unchanged. Convertible preferred stock use the if converted method. If converted, the company would not pay preferred dividends. That means net income available to common shareholders increases. Numerator goes up. Plus, conversion adds new common shares. Denominator goes up. The unique effect of convertibles is the increase in net income available to common shareholders. The correct answer is A. For the preferred dividends, you add back the entire amount, $100,000, because dividends are not tax deductible. For the bond interest, you only add back the after-tax amount because the loss of the tax shield must be accounted for. The dilution rule. Diluted EPS is only reported if it is lower than or equal to basic EPS. Here, basic EPS is $12. Since $11.30 is lower than $12, the securities are dilutive. Only count the new shares for the portion of the year they were actually outstanding, from September 1st to December 31st. Options don't change profit. Exercising options is assumed to have no effect on the net income, the numerator. It only affects the number of shares, the denominator. Logic of buyback. You don't just add 50,000 shares. You must subtract the shares the company could buy back with the option money to see the true dilutive impact. Diluted EPS includes only potentially dilutive securities. A security is dilutive if its conversion or exercise will decrease EPS, make EPS lower. If conversion would increase EPS, it's anti-dilutive. It is excluded. Stock options, warrants, convertibles, all tested individually. Only those that reduce EPS are kept in the diluted EPS calculation. Retroactive rule. This is the most important part. You don't just apply the split to the shares outstanding in October. You apply it to the entire weighted average for the whole year. Remember that new shares are only counted for the fraction of the year they existed. Since the new shares arrived on April 1st, they only count for 9 out of 12 months, 75%. In the diluted calculation, we don't subtract the 1 million dividend. This is because we assume those preferred shareholders are now common shareholders, and the company keeps that cash for the common pool. Always check if the diluted figure is actually lower than the basic figure. Since $5 is lower than $7, the security is dilutive and must be reported. If it had been higher, it would be anti-dilutive, and the difference would be zero because you would report basic and diluted EPS as the same number. The $50,000 in common dividends is extra information designed to distract you. Only preferred dividends are subtracted from net income to reach the numerator for basic EPS. Even though the split happened at year-end, the retroactive rule is to treat it as if those shares existed from day one of the year. Basic EPS is net income available to common shareholders divided by weighted average shares. Diluted EPS adjusts for potentially dilutive securities, options, convertibles, warrants. The rule is only include securities that reduce EPS or dilutive EPS. If conversion makes EPS higher or anti-dilutive, those securities are excluded. Therefore, when convertible preferred stock conversion increases EPS, diluted EPS is reported as equal to basic EPS. This topic is about income statement ratios and common size analysis. A common size income statement shows each line item, such as expenses, taxes, net income, as a percentage of revenue or sales. This makes it easier to compare companies of different sizes or compare one company across different years. It is not based on total assets. That's for a common size balance sheet. It is not just for tax rate calculation. Trend analysis of absolute expenses shows whether costs are rising, but doesn't reveal profitability relative to revenue. Debt to equity ratio comparison measures leverage, not profitability. Common size income statement expresses each line item as percentage of revenue, so you can see if margins like gross margin, operating margin, net margin are improving even as revenue grows. Absolute numbers alone, such as revenue grew 300%, don't tell if profitability improved. Common size income statement normalizes everything to revenue, best way to see margin changes. In common size analysis, interest is considered a non-operating item. It is subtracted after the operating profit is calculated, so it should not be used when you are specifically asked for the operating margin. Even though company alpha has lower expenses in total dollars, company beta is actually more efficient at turning its sales into profit. Standardizing the numbers into percentages allows you to see this clearly. Always look at the final bottom line first. Since the net income percentage is increasing, option A, which claims profitability is declining, must be incorrect. Remember that common size statements express everything as a percentage of revenue. This standardization is what makes it possible to see that the 5% saved in operations perfectly balanced out the 5% increase in production costs. Common size statements are powerful because they remove the effect of size and clearly highlight different management choices, like whether to spend money on innovation or keep costs as low as possible. Company beta is likely pursuing a cost leadership strategy. They spend very little on R&D, so they can potentially sell their products more cheaply, even though it results in a lower profit margin per sale.